first one of these 26 stocks. I do not own it right now. And I'll tell you also if all these 26 stocks, if I own it right now, if I don't own it, right? Ulta Beauty. This is on my watch list. This is a pretty interesting stock. If you don't know Ulta, they're a big cosmetics company. They got physical locations all over the place. They also have a good online presence as well, e-commerce presence, right? And when it comes to Ulta, it's a pretty simple one, right? Not the most complex business model. They also, by the way, in a lot of their Ulta stores, they also can do your hair and get a facial and other things like that, right? But in regards to Ulta, forward P on the stock 15, 2-year forward P under 13. Next year expected earnings per share growth, kind of looking at what analysts are expecting here, 12%. Looking at 1000xstocks.com. Next year revenue growth expected a little under 8%. If we just run some numbers, which I think these are pretty fair numbers for Ulta over the coming years, around 8% revenue growth a year, 2025 to 2028, and around 12% net income growth. That would put the company at net income margins of about 12% come 2028. Now, if you're saying somewhere between about a 15 to 20 P ratio, which is fair for an Ulta, right? 15 to 20 P is about fair for the stock. You'd be looking at somewhere around a $650 stock price to about $866, which gives you a compounded annual growth rate on the low end of about 15%, on the high end 23%. So Ulta actually looks pretty darn attractive here. Second stock of these 26 is Boston Beer Company. Ticker symbol on this one, SAM. It's a $269 stock here today. I don't own it as of right now. If you don't know them, they own a bunch of different brands. The Truly brand, Twisted Tea, Sam Adams, which just Sam Adams alone has a bunch of different like flavors and whatnot. They get the very popular Oktoberfest that I'm sure you're going to see in every dang grocery store and every store that sells beer out there over this next 2 months roughly, right? They also own, what's this one called? Angry Orchard, I believe it's called, which is fairly popular. So in regards to this one, it has a 2-year forward P on it of about 21 right now. Forward P is about 28. Next year, earnings per share growth is expected to be very strong. Basically, this company lost their way over the last few years. What happened is, obviously, Rona happened, right? And that really affected I would say, the overall alcohol industry, people getting together, which, let's be honest, like, Rona changed a lot of things there in the short term, right? There was no getting together. There was no going to the bar, no going to the club for a while, right? There was no, big family get-togethers for the most part for about a year or two there. Then we had a big kind of bunch of people getting together as the world opened back up and we could go do things again. And that was positive for the sales. But then they got too much inventory, it piled up, and in regards to them, like, inventory has to be fresh all the time because it's beer, right? So they kind of ran themselves into kind of a screwed up situation. So their profitability should come back very strong here. Now, if we run some projections here, and let's assume they can do about 6% revenue growth, which is kind of what analysts are expecting, and then run about 33% over the coming years, you'd be looking at a very nice CAGR here, which I think they could actually get here. 14% net income margins in 2028, and to do about $2.5 billion on top line, I don't think it's crazy at all for Sam, which would give you a very nice compounding annual growth rate on this stock. Next one up here, number 3 at 26, don't own it as of right now, is Lululemon. Ticker symbol Lulu on this one, $260 stock. Obviously, they have their retail stores that you'll see in a lot of nice malls. They're known for their yoga pants. They sell a lot of other items there. You can go to Lululemon and see, like, they got a lot more than just yoga pants. But let's be honest, like, that's their product that made this brand super famous. That got everybody to know it, right? That's what they're known for. And they've been facing more competitive pressure here recently. Now, this one, forward P on this one around 19, 2-year forward P around 16. Next year earnings per share growth expected about 13%. Next year revenue growth expected about 15% on this one. So if we run about 15% revenue growth, which by the way, their international opportunity is pretty immense, and they're just really starting, they're kind of in like, I think the first or second inning of their international expansion. They got a long way to go there. So I don't think it's crazy to imagine 15% revenue growth, net income growth of about 13% or there, right? Which would just kind of say they're spending heavy on marketing as they expand internationally. So kind of their profitability isn't able to keep up with the revenue in regards to this. And you slap a 15 to 20 P on this, you got a pretty good CAGR story here. Compounding annual growth rate on the low end about 11 and on the high end about 19. And those are very fair P ratios there. So I think Lulu actually looks pretty interesting here. The reason you might say, why haven't I bought it? I'm just still trying to figure out, is there a systemic overall problem with Lulu's brand? That's what I'm a little concerned about, because it is hard to grow into becoming a Nike, and that's what they really need to do to become this, to get to this next step, right? Now you're seeing here today, I'm using a lot of 1000xstocks.com. You're going to see that. If you want access to the service, I'll put his pinned comment down there today. You can apply for access to 1000x, my private stock group, my private wealth group, all those sorts of things in the 1000x advanced education portion. It's not just about all the software, different programs you get to use in regards to 1000X. It's also about the education portion. If you need help understanding balance sheets, income statements, cash flows, how to perform SWOT analysis, strengths, weaknesses, opportunities, threats, how to understand if a company has a strong moat versus a weak moat, how to value dividend stocks, how to value growth stocks properly, dividend investing, portfolio management, and many other subjects. If you need access to all that, pin comment down there. You're going to fill out an application. We see if we can get you access to 1000X as well as my private groups, okay? Alrighty, guys, next one up here, number 426 is RH. I don't own it right now, and I'm sad. Stock's up 18% after hours right now. Yes, 18%. I'm not a happy camper about this at all. No, not at all, okay? Now, RH, very high-end furniture company. They don't have much for competition there, which is phenomenal. They're really going after the top 10% of income earners, the top 10% of net worth, and it's actually a pretty good strategy to really go after the top end here, because most furniture companies are really focused on the masses, right? They're focused on the middle class, and there's not a lot that really have scale, right, in really selling to high end. And remember, if you're selling to, let's say, somebody that, makes $50,000 a year, you got to understand how much they're going to spend on their furniture in an apartment they're going to get or a home. Very small amount of money, right? They might spend $1,000 or maybe a couple $1,000s on furniture, right? They're going to probably be at IKEA or some other mass market store. However, you sell to a high net worth individual who lives in a $10 million mansion, they're going to probably spend around $250,000 to around $500,000, right? You had an option. You had this customer or this customer. One you got to sell to $250,000 worth of furniture to. One you got to sell $1,000 worth of furniture to, right? So both can be successful, by the way. That's why IKEA is very successful. And then there's RH, which is very successful. It's just they cater really to the top end. Now, their latest, this is the numbers they just reported. Numbers weren't good. Their revenue was up a little bit year over year, which is nice, but their cost of goods sold went up to 54.8%. Gross profit went down for the company to 45.2%, right? Selling general administrative expenses went through the roof. It was up about $50 million year over year, and their revenue wasn't even up close to $50 million. Income from operations dropped to 96 mil from 151 mil. Keep in mind, this quarter last year wasn't even a good quarter for them. Interest expense for this company up 7.2%, right? Because of their debt levels. That's not good. Net income down to 3.5%. These numbers are bad. They're really bad numbers. But you might say, why is their stock going up? Well, there's a feeling that maybe their business is bottoming, right? And also, do remember they get to comp against these numbers next year, which will be nice for them, right? Because these are pretty pathetic numbers. And so hopefully they can report much better than this next year, right? And so, RH, I'm not in a rush to get in the stock. I still don't even know if tomorrow's move, the 18% move, I don't even know if that's going to be a real move. I wouldn't be surprised if next thing you know, stock's back at 250 level. I don't know. We'll see. But for now, it's still on my buy list. Number 5 of these 26 is AMD, Advanced Micro Devices. I don't own the stock right now, but AMD is pretty intriguing here, right? AMD, forward P on this one, 43, 2-year forward P 25. We do have to admit AMD's been getting their butt kicked by NVIDIA for really the past 2 years, but it's looking like AMD's positioned themselves much better for 2025 and beyond. Next year, earnings per share growth is a shocking 129% expected for this company. Obviously, next year, and then next year revenue growth expected 27% for AMD. Now, AMD, here's the deal, okay? If you want to run it at low PEs, the CAGR is not very exciting. But if you are expecting this company, let's say, command more of a 30 PE or 40 PE, then you could say the CAGR is going to be very attractive. I just want to run in here with very conservative PE ratios of 15 to 20. And obviously that doesn't look that great as far as the CAGR, right? 3 to 11%. But once again, double up those, and all of a sudden you're talking about CAGRs that are significantly above where we're at there. Hey, it's Jeremy. I hope you really enjoyed that clip here today. Listen, there are 3 main areas a long-term investor has to understand. You have to understand financial statements, income statements, balance sheets, cash flows. You have to understand and master portfolio management, and you have to have the ability to project what is possible for companies in the coming years. Bearish scenarios, bullish scenarios. All these skills can be learned, and that's the good news. And I'm still just a regular guy who's out here. I just have a lot of passion for the market. I've learned a lot over the last 15 years. I had a tremendous amount of success, and I have a dedication to teaching people everything I have learned in the past 15 years. If I can do it, you can do it too. You can learn all that's required to become a great investor in my private group. The application is going to be down there in the description area. You can click on that, fill out an application, join us in the private group, get access to all my best course curriculums, teaching you everything that I got in my head. And you get ability to join our 6-figure, 7-figure Hall of Fame. We have such a tremendous Discord. It is incredible. So once again, description area down there, there's a link. You can apply to join my private group in there. UPS, number 6 at 26. I don't own this stock. And first thing I want to say about this stock, it's a very sad stock. It really is. I went, this is an all chart for UPS going all the way back to roughly 2000 or so, right? The stock's up 97%. And all those years, like 25 years, and the stock has 97% gain to show for it. Really bad performance from UPS over time. We know they're a massive delivery company, logistics company, right? Now, I'm looking at UPS here. Forward P is around 16, 2-year forward P is 12. Keep in mind, just because the stock's been bad in the past does not mean it's going to be bad in the future, right? Next year, earnings per share growth expected 36%. They're expected to get their earnings per share growth going in the right direction again in a very substantial way. They're a company that inflation really screwed up their business model in the short term big time. Next year, revenue growth expected about 7.5% in this company. So if we run some projections here, obviously next year should be a great year for earnings per share growth, but let's say then it averages out to 8% after that. And let's say they do revenue growth on average of about 8% over the coming years, which I don't think is crazy to imagine. You're looking at a stock and you value the stock at a P/E ratio of 15 to 20, right? Net income margins of only 8%, so pretty bad, but it's a delivery and logistics company. Like, you're not going to command crazy net income margins on a physical business like this, right? Then put the CAGR on the low end of about 18%, on the high end of about 16%. So I think UPS is actually a buy here. Not the most exciting stock in the world, but I do actually think it's a moneymaker for the next 3 or 4 years. Next stock up here, number 7 at 26, is Elf Beauty. I do own this one. And I will say, very few times you could ever make 1,400% on a stock and you still feel like it's a buy. And looking at Elf, looking at the valuation of the company, the growth rates, stock is still a buy, even though I've made so much money on the stock over time. Now, I spoke about Elf extensively, literally less than 2 days ago. I did this video. I spent $32,000 on the stock today. That stock was Elf. And so if you want to hear me talk very in depth, I spoke about some other subjects in that video, but if you want to hear me talk very in depth about Elf specifically, watch that video, because that was, I think I dedicated probably 20 minutes or 25 minutes just to speaking at the beginning of the video. The first 20 to 25 minutes were just dedicated to speaking about Elf stock, okay? Next one up here, number 8 of 26, is Whirlpool Corporation. Not a stock I own right now. Nope, not a stock I own, but it's actually one of those stocks that is kind of like UPS in terms of it seems like a really boring stock, but I wouldn't be surprised if it's a really nice moneymaker this next 3 or 4 years. Now, like if we look out 3 years from now, 4 years from now, I wouldn't be surprised if Whirlpool's like a $200 plus stock. Now, Whirlpool, we know it makes appliances, refrigerators, microwaves, ovens, dishwashers, to do your laundry, all those sorts of things, right? But here's the deal, all right? Mortgage rates are starting to come down, and they're likely going to continue to come down. For my guess is they're going to continue to come down for the next 2 years. 2 years of mortgage rates coming down and down and down. And then I think they'll probably bottom out, probably stay there for maybe 1 to 2 years, and then they'll start probably moving up again. So we're going to be in a declining mortgage rate market for a while, and then I think we'll be at a kind of a stagnation of mortgage rates where it's not going to really go up or down for very much for an extended period of time. So I think the next 5 years are set up pretty good for a company like Whirlpool, right? And it's clear as day, obviously, mortgage rates have already started to come down. And keep in mind, we've been in these incredibly high mortgage rates for about 2 years now, over 2 years, which these are the highest mortgage rates people have had to pay in decades, right? You got to go really all the way back to about 20 years ago almost to see us anywhere remotely close. And even back then, we still didn't even get up to as high of mortgage rates as we really have been up to here recently. We've had a lot of mortgage rates recently of 7% plus, right? You didn't even have that back here in this situation. Nope. So the moral of the story is, in regards to these mortgage rates, is I think they're going to continue to come down. I think we could see an uptick in the amount of people moving 2025 through probably 2029. And I think that bodes very well for Whirlpool's business, because a lot of people, when they do move, they end up getting new washers and dryers and those sorts of things. And so ultimately, it's actually, I think, a pretty interesting stock. I would love to see it go down to a 70 level or 80 level, but even here, it's actually rather interesting, right? And we know mortgage demand's been the lowest, I mean, in modern times, really, over the past year or two. I don't expect that to last. I do think things will pick up 25, 26. And by the way, that doesn't mean pricing of homes will pick up in 25, 26. A lot of people are assuming because demand's going to pick up in terms of people moving that suddenly that's going to make prices jump higher. You got to keep in mind there's going to be probably a lot of inventory that hits the market in 25, 26 as well, right? And so that's just something to factor in. If you talk about a higher unemployment rate, maybe people are a little bit more desperate. These are things to all consider here, right? So you could have a lot more people moving, a company like Whirlpool numbers improving, but the price of homes not necessarily going up. So just something to factor in.
Hey, it's Jeremy. I hope you really enjoyed that clip here today. Listen, there are three main areas a long-term investor has to understand. You have to understand financial statements, income statements, balance sheets, cash flows. You have to understand and master portfolio management. And you have to have the ability to project what is possible for companies in the coming years. Bearish scenarios, bullish scenarios. All these skills can be learned, and that's the good news. And I'm still just a regular guy who's out here. I just have a lot of passion for the market. I've learned a lot over the last 15 years. I had a tremendous amount of success, and I have a dedication to teaching people everything I have learned in the past 15 years. If I can do it, you can do it too. You can learn all that's required to become a great investor in my private group. The application is going to be down there in the description area. You can click on that, fill out an application, join us in the private group, get access to all my best course curriculums, teaching you everything that I got in my head, and you get ability to join our 6-figure, 7-figure Hall of Fame. We have such a tremendous Discord. It is incredible. So once again, description area down there, there's a link. You can apply to join my private group in there.
Ed Jordan Denny, ultra dovish cuts may be off the table after CPI report. What?
Great to see you again.
I don't know if I agree with this.
Thank you. I know you've written last few days about expected chop in September. You wrote about China last night, but I wonder, does this core CPI print, should it be considered a threat to the doves?
Well, I think to the extent that there was some heightened expectations that there would be a 50 basis point cut in the Fed funds rate next week, which would be sort of the ultra dovish position. I think that's off the table now, and I think you're more likely to see 25 basis points. I shouldn't say it's off the table. I really don't know what the thinking of the Fed is, other than that they've certainly pivoted away from being concerned about inflation to being more concerned about keeping the unemployment rate down. But the data today was pretty good. Take out rent, and the headline inflation rate was 1.2%. We've been talking about getting to this level for a few years. We thought that it would come down. So things are going right on inflation, and I think the surprise is going to be that the economy is more resilient than people are thinking.
If that's true...
If you're wondering why was the stock market down so much earlier this morning, right, and why did it come back, my belief is the early drop, because here's the thing, before I went to bed last night, futures were already dropping big after what happened last night, the debate, right? And, the consensus certainly was Harris won the debate. And so being that the consensus was Harris won the debate, people could view that as, her odds of winning the election go up in that sort of situation, right? And so therefore the market has to price that in. The market doesn't necessarily love some of her tax policies and those sorts of things, right? We know about that. And some of the changes she wants there. And so the market was kind of pricing that in. But then you got CPI, and ultimately, do I think the market took this CPI as a positive? My belief is yes. I think, CPI coming in at 2.5, I believe the market liked this CPI report. I believe this was a CPI report that, months ago I called the dragon been slayed, right, in regards to inflation. This was a sort of CPI report that if you were on the side, if you were still uncertain about inflation, right, this has to be the CPI report that just slays the dragon once and for all in your mind, right? If you're still worried about inflation at this point in time, I don't know what to tell you. Look at what's going on in the commodities market. Look where these commodities have been heading the past year, right? Look what you're seeing in all this different data. If you don't like the government data, go look at trueflation numbers, right? there's just, I think if you are still in the camp of inflation's this big problem. The Fed has to worry about that. I just think you're way off sides in regards to this. That was like the game of a year ago, 2 years ago. We're on a new game now, and the Fed's number one focus and attention really has to be on the economy and the employment market now at this point in time.
What did you make of the bank commentary yesterday, and did that move the conversation meaningfully?
Well, Carl, I only listened to what supported my story. The fellow from Bank of America, Brian Moynihan, certainly was very positive on that. Jamie Dimon's been kind of pessimistic about the outlook since May of 2022. He's been a long-time pessimist. But I think, look, you can't really generalize about the consumer. We clearly have consumers that are struggling, that maybe have maxed out on their credit cards. But then we also have plenty of other consumers, particularly the baby boomers. Let's say there's 70 million of them that have $78 trillion worth of assets. A lot of them are retiring, and that's why the savings rate's down. And they're spending money. There's no doubt about it. They don't have mortgages.
True.
They don't have to pay for college education. So I think it's a mixed story on the consumer. And when you kind of add it all together.
And that Social Security's been getting bumped up, right, with all this inflation. So that's true.
It still looks pretty good. As you know, the Atlanta Fed estimate for consumption during the third quarter, real consumption, is 3.5%. That's gangbusters.
I'm thinking of all the big things you've written about, Ed, in recent quarters, namely the generational transfer of wealth, right, which you've talked about, the productivity progress we're making, and the export of deflation out of China. Shouldn't those all be considered positives for the U.S. economy?
Absolutely. I think the U.S. economy is the big winner here. You know, when the Fed started raising interest rates in 2022 through 2023, it was logical to believe that tightening of monetary policy would cause a recession. And the reality is there was a recession. It just happened to be in China. They have a property depression, and they're exporting deflation. And that's one of the reasons that our CPI inflation rate has come down so rapidly, is because durable goods inflation, and we import a lot from China in that regard, that's come down into deflation again. So, yeah, absolutely. All those things are good for the economy.
You might say, why are some of these solar stocks bouncing big here today? Well, you know why. Come on, put the pieces together. The debate last night, right? That's why you're seeing First Solar up big here today. That's why you're seeing Enphase up big here today.
And positive for the stock market.
Ed, did you read the Beige Book? I mean, more districts contracting. I mean, also, it does jibe with some of the recent commentary. I was looking at Dave & Buster's today, not necessarily that that's the most indicative of the economy, but tough kind of consumer environment. Many others are feeling the pressure. Petco CFO, choiceful and value. If you listen to companies and look at the anecdotes, it's full of weakness and softness on the labor market, on the consumer.
100%, and that's why the Fed needs to get moving here. 50 basis points. You know, everybody's acting like, oh, they got all this time in the world. They got to get moving, man. They got to get moving. 50.
A very good point. It just seems that a lot of the survey sort of data has been more pessimistic than the actual data, and it's the actual data that matters. I mean, real GDP is running at 2.5%.
The actual data, Edgar and Denny, in all due respect, sir, when you say the actual data, you talking about the government numbers that we know they get screwed up all the time and they manipulate? Come on, Ed. I don't know.
During the current quarter, and that's even with July being affected by the weather. And as I said before, the consumer is running, as the run rate is 3.5% in the third quarter. So I think that for some reason the surveys are picking up a more pessimistic tone than the data is actually reflecting. Initial unemployment claims remain extremely low. Everybody kind of got bummed out by the payroll employment report for August, but actually the work week rose, and so aggregate hours worked is an all-time record high. And I think retail sales are going to surprise to the upside, as will personal income, because not only did we have more people working in aggregate in terms of hours, we also had a nice increase in wages. And to the point you made, Sarah, about real wages, they're absolutely up. And Lael Brenner was absolutely correct in saying that can only happen with productivity doing well.
We'll see what retail sales brings us, Ed. Interesting to get your forecast on that, and hopefully talk around that as well. Good to see you.
Yeah, so the bottom line is right now, right? You look forward to getting into Mike Wilson. I hadn't heard Mike Wilson talk in a while. This is going to be interesting here. Mr. was very, very bearish over the last couple of years, but I think he might be flipping. So here's the deal, okay? CPI 2.5. Fed funds rate, where's that at? 5.25 to 5.5. So we have about 300 basis points, right? 300 basis points of too much, just the Fed's way too tight. The Fed's way too tight right now. 300 basis points too tight? That's an extreme amount. In a perfect world, you would say the Fed should lower interest rates 300 basis points. They should lower by 3 full percentage points. Now, right? They're not going to do that because that causes all types of markets to gyrate. That would cause crazy volatility in the bond market and treasury markets and all those sorts of things. So they wouldn't do that, right? They're going to have to go over a course of 12 months or whatever, right? Or 18 months. But they have to get moving here. Do 50s, 50s, 50s. Why not? Like if I could talk to Jerome Powell right now, and I could talk to all those Fed people, and they let me speak up at the table for 2 minutes, I'd say, why not just go 50s nonstop for the next several months? What are you scared about? Inflation? That's not an issue. We know that's not an issue. CPI is at 2.5. Commodities market's dead for the past year. It's not doing a dang thing. So that means that bodes very well for next year's inflation numbers, right? What's the deal here, right? We know the employment picture is getting softer. That's clear as day, right? We know companies, for the most part, have okay things to say or bad things to say, right? You're getting all the data to really kind of justify, like, we got to get moving here, man. To go 25 and then a 25, oh my gosh, man. It's going to take us 100 years to get these Fed funds rate down. And the longer that takes, the more damage you could cause to the economy, and the more you're going to end up in a huge, huge situation. And then it's going to get ugly because then the Fed's going to have to come in, try to backstop everything. The money print that's going to go on, right? It's ugly. So just get ahead of that. You know, they go 50s right off the bat here. You know, 50 to end the year, 100 basis points, and then keep it moving in 2025.